Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we're diving into Mersana Therapeutics' latest proxy statement, and let me tell you, it's more than just boardroom chatter. We're talking potential stock splits and executive pay, so buckle up because this could get a little wild. Mersana, as we call it for short, is a drug company. They're developing new antibody technologies for cancer patients. They're not making money on drug sales yet, so we will focus on how they are trying to position themselves for the future instead. We have the standard but important stuff like director elections and auditing firm ratification, but the real juice, a proposed reverse stock split, and of course the always interesting executive compensation details. First up, the election of directors. Alan Diaz, Andrew Hack, and Kristen Hadge are up for re-election to the board. These folks help guide the company's strategy. The board recommends voting for them, so they believe these are the right folks to continue leading Mersana. The filing gives us the background of the directors. We have people like David Mott, chair of the board, a private investor. Then we have Martin Huber, the president and CEO, who is also a doctor. It's good to see a blend of financial and medical expertise guiding a company like Mersana. Next up, some corporate governance housekeeping. The board says that most of the directors are independent, meaning they don't have any close ties to the company management that would compromise their judgment. This is important for keeping the board objective and accountable. Let's peek at the board committees. There's the audit committee handling finances, the compensation committee deciding executive pay, and the nominating and corporate governance committee finding new board members and ensuring good governance. These committees are critical for oversight. All right, let's talk director pay. Each non-employed director gets a base of $40,000 a year and then extra for being on committees. Plus they get stock options. It's pretty standard compensation to attract qualified people. Now let's get to the main event, executive compensation. We've got a table showing what the top executives made in 2024. Martin Huber, the CEO, made over $1.6 million. That's a combination of salary, stock awards, and a bonus. This is a big increase from the year before. Keep that in mind as we see the rest. Let's scroll down a bit. Brian Deskeitner made around $1.54 million. Compare this to his 2022 salary of just over $1.2 million. So he's getting paid quite a bit more these days, but there is more to it. The company gave him a larger role, so they adjusted the compensation. Let's see. Mahan Bala made $1.5 million as well, very similar to Deskeitner. Timothy Lowinger got paid $1.4 million. As you can see, there are a lot of adjustments to this amount, which is common as it includes the value of the stock awards that can have volatile swings up and down. So what about the bonuses? The filing explains that the executives get bonuses based on both corporate and individual performance. The company achieved 85% of its corporate goals in 2024. There's a specific formula for how the bonuses are calculated, but the main thing to note is that it's tied to how well the company does overall and how well each executive performs individually. The compensation committee has a say in all of this, and they make sure things are fair. While bonuses can change, the overall framework is designed to incentivize and reward performance. Looking at the equity awards, we see that the executives get a mix of stock options and restricted stock units, or RSUs. Stock options give them the right to buy company stock at a set price, while RSUs are like promises of stock in the future. Most executives get stock options valued twice the RSUs. To make these decisions fair, there's even a company called Pearl Meyer, which is hired by the company to make sure all numbers are aligned with industry and competitors. There are also rules about how much stock the executives should own to align their interests with those of shareholders. We like that. Everyone should be incentivized to have skin in the game. Here's the big one, a proposal to authorize a reverse stock split. Basically, the company wants the option to combine a bunch of existing shares into fewer higher priced shares. Why? They want to keep their listing on the Nasdaq stock exchange, and sometimes a higher stock price makes a company look more appealing to investors. They're asking for approval to do a reverse stock split at a ratio of 1-for-2 to 1-for-25. The board would get to pick the exact ratio, and they might not even do it at all. It's all about flexibility as they try to navigate what's best for the company. The filing makes clear that main goal of this potential reverse stock split is to maintain its listing on the Nasdaq. The stock needs to stay above $1 and reverse split is one option to do that. Otherwise, they can get delisted. Of course, there are risks. It might not work and the stock price could still decline. It could also make the stock less liquid, meaning it's harder to buy and sell. But the board thinks the potential benefits outweigh the risks in this case. If the reverse split happens, it won't change the par value of the stock or stockholders' rights. It's just a cosmetic change to make the price per share look better. Finally, there's some tax info for US stockholders. The reverse split should be tax-free except for any cash you get for fractional shares, but as always, consult your tax advisor. So what's the story here? Mersana is trying to steer its ship toward a brighter future. They're focused on developing those promising cancer treatments, keeping the company listed on the stock exchange, and making themselves attractive to investors. A reverse stock split can be a bit of a gamble, but the company seems to think it's a risk worth taking to continue moving forward. Now, for my take, Mersana faces both significant opportunities and risks. Its innovative ADC platforms could yield blockbuster drugs, but clinical trials are costly and success is never guaranteed. For me, I would take special note of the company's ability to manage expenses and secure future funding. It is a balancing act. Here's the execution of their strategic collaborations with larger pharmaceutical partners. The reverse split gets approved. You should keep a close eye on how those shares perform. In summary, Mersana needs to successfully navigate the complexities of drug development and market dynamics. We'll have to wait and see if their plans pay off. Thanks for tuning in to Corporate Decoded. Don't forget to like, subscribe, and leave a comment below.